Hello and welcome to the lecture for Chapter 1 for Accounting 450. So in this chapter, we kind of take a 10,000 foot overview of the profession, talk about what the nature of assurance services are, which is a larger category than just auditing. We'll talk about what attestation means and what forms that takes relative to accountants. Talk about the nature of financial statement accountants, why there's a demand for audits. I'll talk about credibility for the accounting profession, different types of audits and types of auditors, and then the regulatory process for auditors, and then the organization of a typical auditing firm. So if you put yourself in the position of an investor, let's say that you've inherited $100,000 and you want to invest in some companies to get a better return than you can off of, say, a certificate of deposit or a savings account or something like that. There's two types of risk that you face with your investment. One is business risk, which is the risk that the business isn't going to succeed in the purpose that they're pursuing. So they'll make a bad decision, they'll launch a product that nobody wants, they'll face competition they didn't anticipate, employees will make mistakes and products will fail in the field, causing the business to fail. So it's those kinds of business related things that can happen, of course, to any business. Think about if you had invested in Boeing and the next day a large number of their planes were grounded because of a defect. That's a business risk. So that kind of business risk can be addressed by timely, relevant, and reliable information. Timely in the sense that you need to know about something in time for you to make a good decision about investing. Relevant, obviously, it needs to be relevant to the company and relevant to your investment. And then reliable. It can't be a rumor. It has to be something that you can depend upon. So there's ways that you can mitigate that business risk in terms of making an investment decision. And that's by having more information. And that more information is driven by, one, the complexity of investments today. Think about companies that might have derivatives on their balance sheet or cryptocurrencies or things that are very complicated. It may be very difficult for you to determine the health of a company looking at their balance sheet if it contains complex items like that. So more information is needed to give you a comfort level for that. Another is remoteness. With businesses doing business all over the world, you can't go there and kick the tires and see it for yourself. So you depend on information provided by other people. Time sensitivity, of course, is important as well. Things are moving more rapidly. And then the consequences. So a very minor thing might not be something that would cause you to make a different investment where something major would. The other type of risk is information risk. So that's an additional risk on top of business risk. And that's the risk that the information that you're being provided is either false or misleading. And that can happen for a variety of reasons. It can happen because of honest mistakes or ignorance. It can also happen deliberately. And that can range from management being overly optimistic about the information they're providing to you, or it can go to outright fraud, that miscommunicating something on purpose. So the thing you have to keep in mind is that the management of a company has a different incentive than the owners of a company. The owners of a company want a return on their investment, both short-term and long-term. Management wants to keep their job and improve their pay, increase their bonuses, that sort of thing. So the management of a company and the ownership of a company sometimes can find themselves at cross purposes, and that can lead to greater information risk. The way to mitigate that information risk is to have an objective, independent third party that provides assurance about the information that you're being given, that you're making your decision upon. So the assurance of management claims is called attestation, and that can range across all types of financial and non-financial management claims. So it could, if a company claims that they are carbon neutral, how do you determine that that's really true? Obviously, companies have an interest in attracting customers and employees by being seen as being environmentally responsible. Well, how do you know that they really are? Some independent third party needs to verify that and vouch for it, in effect. So attestation of financial reports is called auditing, and that's the subject of this class. When management produces a set of financial statements, they're making claims about what actually happened, and an independent third party, the auditor, is going to provide assurance that that really did happen. So one way to think about it is assurance services is a very broad category. That's a third party, an independent third party, lending credibility to information that's being provided. Okay, and it could cover labor practices, all different kinds of things. Attestation services are a higher level of that credibility that's being granted, and then auditing is a subset of attestation, meaning dealing with financial records. So a good definition from the book, I'll just read it here. An attestation engagement is an engagement in which a practitioner is engaged to issue a report on subject matter or an assertion about subject matter that is the responsibility of another party. So in the case of financial statements, the financial statements are the responsibility of management, and the practitioner is engaged, being the auditor, to give an opinion about that subject matter. There are other areas that I think are tremendously interesting that auditors are beginning to be involved in. One, as I mentioned, is sustainability and environmental practices. So determining if what a company says is actually true and lending credibility to that. Fair trade is another area. So companies that insist that they're doing the proper things in foreign countries, paying people the correct amounts and all of that. So that has to be proven, right? It has to be reinforced with objective third-party information. And then labor practices. If a company claims that they're not using child labor or prison labor or whatever the case is, some third party needs to say, yeah, indeed, that's true, in order for people to believe it. So there are different levels of financial attestation engagements. It can range from the low end there at the bottom of this chart of agreed upon procedures. So somebody that comes in just to look at inventory or just to look at internal control or whatever the case may be. There could also be in that category what's called a compilation. So sometimes small companies will have a bookkeeper but not an accountant, and the bookkeeper can produce a trial balance but not financial statements. And so an accounting firm may come in and do a set of financial statements for the company. In that case, it's very clear that they're not issuing an opinion about the validity of the numbers. They're just putting the numbers in an acceptable format. The next level up is a review. So that's where they come in and do basically analytical work. So the analytical procedures to say, do these numbers look reasonable compared to past years, compared to benchmark companies, a whole variety of different ways that they can do that, but they're not doing an examination. They're not checking the inventory count or contacting customers to verify receivables, those kinds of things. And then highest level is an examination or an audit. That's where they don't take anything that management says at face value, but look for outside evidence for everything. So a definition of an audit, auditing is a systematic process of objectively obtaining and evaluating evidence regarding assertions about economic actions and events to ascertain the degree of correspondence between the assertion and established criteria and communicating the results to interested users. There's a lot packed into that sentence. So first of all, being a systematic process, that means that there are procedures that auditing firms follow, so they have some assurance that each audit opinion that they issue has been done in a correct manner. It isn't done one way here and another way somewhere else. The evidence that we're talking about is third-party evidence. So as an auditor, I wouldn't accept something the company produced as evidence. I would look to something from a third party. So as an example, if a company says, yes, we own this fleet of trucks, I would want to see a title for the truck showing that the company is the owner. If they say that these 10 people owe us money, I would contact those 10 people or a sample of them directly and determine from them that they owe that money. So it's always going to an outsider to get documentation of something. And again, assertions are claims that management makes about financial figures. So if they say that they have $100,000 in the bank, they're asserting that that money is owned by them and is available to them and actually exist. If they say that their sales were $20 million last year, they're asserting that those sales, those transactions actually took place. The word established criteria there in the US, that would be relevant to generally accepted accounting principles. Internationally, it would be IFRS. So here's a little overview of kind of the process. So at the top there, management is responsible for producing the balance sheet, the income statement, the statement of cash flows, and then footnotes to support that. And they're making assertions about these sales actually happened, these expenses were incurred, we own these assets, we have these legitimate obligations to pay other people. They're making assertions about all of the facts and figures and information that's included in those. So an independent auditor is going to have knowledge of the business. They're going to make observations, inquiries, confirmations with third parties, inspect documents. They're going to do that relative to the financial reporting framework. In the US, it would be GAAP. And when they're finished with that, they'll produce an audit report that says, we've looked at these financial statements and we believe that they comply with generally accepted accounting principles or not. So the different assertions that are made by management about financial statements, one is they are claiming or asserting that transactions and events occurred in the period in question. We'll talk quite a bit in this class about cutoff. So did the sale take place on December 29th or January 2nd? Those kinds of things. That account balances actually exist, that if we say we have prepaid insurance, we actually have prepaid insurance and we can prove it. And that physical assets actually exist, like inventory and trucks and things like that. That the presentation and disclosure of information is accurate and complete, that we haven't made errors of omission, we haven't neglected to convey bad news, as an example. That all of the assets exist and that the income statements events actually occurred, that we actually made the sales we claim. Rights and obligations, that the assets we show on our balance sheet, we have rights to those assets, ownership rights. They're not leased or rented, and that all of the obligations shown on our liabilities side of the balance sheet are actually our obligations, and we've included all of them. We haven't forgotten some of them. And then completeness, that everything should have been recorded has been recorded. So professional skepticism is something that auditors need to employ, and trust but verify is kind of the approach there. It's a little bit tricky in the sense that it requires diplomacy, because the client is who pays your bills, that's who pays the auditor's salary. So you have to kind of have a questioning mind and look for hard evidence, but not call somebody a liar, that kind of a thing. So you have to be aware of that conflict of interest and manage that appropriately. So oversight of the profession, the American Institute of Certified Public Accountants, AICPA, is a professional organization. They establish standards and rules for the professional services that accountants provide. Among those is statements on auditing standards, SASs, which are directives about how auditing should be done. If firms don't comply with those auditing standards, they are taking on a risk they shouldn't. The AICPA researches new types of transactions, new types of financial instruments and different kinds of assets and obligations, and publishes information about how those should be accounted for. They provide continuing professional education, which CPAs are required to engage in. They prepare and grade the CPA exam, and then they self-regulate the profession, meaning kick people out that don't follow the rules, basically. State boards of accountancy, they regulate the profession within the state, so they can suspend or revoke a license. I have a CPA license and it was issued by the Washington State Board of Accountancy. If there were some question about my license, that's the entity, a branch of the state government, that would deal with that. FASB, or the Financial Accounting Standards Board, that's the group that has been designated to develop and update GAAP in this country. And then the Public Company Accounting Oversight Board is something that came about through the Sarbanes-Oxley Act, and they oversee the audits of public companies, so publicly traded companies. So accounting firms that choose to do audits of publicly traded companies there's oversight provided by the PCAOB of the work that those people do. So the organization of the profession, there are now 4 big international firms: Deloitte, Ernst & Young, KPMG, and PricewaterhouseCoopers, that goes by PwC. They have offices all over the world, and they're really the only firms that are capable of handling very large audits of publicly traded companies like Ford or Google or Amazon or any of those kinds of large international companies. So they have staff all over the world to look at inventory, to do all of the field work. There are a variety of national firms like Grant Thornton, BDO, McGladrey that have offices across the United States that also audit publicly traded firms, but not necessarily on an international basis. Then there are regional and local firms. So Moss Adams is an example of a regional firm. They're in mostly the western U.S. They do some publicly traded audits, but a lot of other kinds of work. And then local firms like McSwain, Strader Hallett, Littlefield, Fanning and Company. Those are firms, the local firms are primarily focused on doing tax work. And then there are sole proprietors, accountants that choose to kind of hang a shingle and do work for the public, and they're generally tax oriented. So a typical accounting firm has a managing partner that is in charge, kind of equivalent to a CEO, and then there are partners in charge in each of their offices. Within each office, there will be tax service partners, audit partners, and advisory, which basically is consulting partners. And then each partner will have clients for which they're responsible. Under the partner would be a manager, and that manager would oversee multiple audits going on at the same time. There would be a senior in charge that would be on site, kind of responsible for the actual field work that's taking place and resolving any kind of issues. And then where you would start if you graduate from college and go to work for an accounting firm, you'd be a staff accountant doing the actual work, preparing working papers, those kinds of things. So there are other types of auditors as well. There are internal auditors that work within a company. Their focus is not necessarily just financial. It's more about mitigating risk for the company and making sure that the company's policies are being adhered to throughout the company. You can imagine a company like Safeway has hundreds of locations, and they want to make sure that if they have rules about, for example, how to handle spilled liquids on a floor and keeping people from slipping and falling, they want to make sure those procedures are being followed in every one of their stores. So an internal auditor would travel around and make those kinds of investigations to determine that. There are government auditors, so both at the federal, state, and local level, they make sure that our tax dollars are being spent as intended. And then there are regulatory auditors. So for different kinds of regulatory agencies, the most common of which is the IRS, of course. So the requirement to become a CPA, you have to have 5 years of college or 150 semester hours. Those can be in any subject, but you have to have a minimum of 24 hours of accounting coursework and 24 hours of business coursework, 24 semester hours, that is. You need to then pass the CPA exam, which currently consists of 4 sections, one of which is auditing. And then you have to work for 2 years under a CPA in order to become licensed. Once you become licensed, then there's a continuing education requirement of 120 hours of education every 3 years so that you stay current. So here's a group discussion. We didn't get to this in class, but I'd recommend that you take a look at that and think about it a little bit, and the solution can be found in the last couple of slides of the PowerPoint lecture that you'll find on Moodle. So thank you for your attention. I'll speak with you again when I lecture on the first part of Chapter 2. Thank you.